And right now, energy or oil, right, is so hot right now because we're seeing, oil prices up quite a bit. So I think it always begs the question, or maybe real assets, should I be using those to hedge inflation? Well, when we look at some of the information, we do see that some of the more like energy stocks or commodities, which include gold, Mark, to your point, do tend to be correlated with moves in inflation. But when you look at the volatility, Mark, they are 20 times more volatile than inflation. So it begs the question, should you be hedging the variability, if you're trying to reduce the variability of something with something incredibly volatile?
Welcome to The Informed Investor, where we break down the latest financial headlines, bringing in research and insights to help you separate the news from the noise.
Inflation has been on the rise to a level we haven't seen since 2023. As an investor, how do I think about that going forward? That is our topic of the day on The Informed Investor. Thank you, everybody, for joining. The show is brought to you by Dimensional Fund Advisors, who is bringing financial science to investing. Today, we have a very special guest joining us, Suyan Murda, Senior Investment Strategist. Welcome to the show.
Thank you, Mark. It's nice to be here.
Good to have you here. Jake DeKinder, always here on the show. Awesome to have you here, too.
I would like for you to note that I knew that Suyan was coming in and she really knows her stuff. So look, I have materials. I'm prepared. I'm ready to go.
The most prepared. And just maybe a little bit of background. The three of us do quite a bit of traveling together and do a lot of different conferences that we host here.
That's right.
At Dimensional. But first time to have you on the show here. So it's great to have you here.
It's nice to be in Austin together. I feel like I only see you guys on the road, really. So it's nice to be here. Yeah.
Yep.
All right, let me start out with the headline, and then we'll start talking about where we are with inflation here today. One headline: inflation, interest rates expected to be higher for longer. And maybe, Suyan, just expand a little bit on that comment there about we've seen a little bit of uptick in inflation and where we are today.
Yeah, I think, Mark, it's interesting, right? We've certainly seen a lot of geopolitical volatility. We saw the last US CPI print come in a tick higher, 3.8%, a little bit higher than what the market expected, actually. And like you mentioned in the intro, we haven't seen a level like that for several years, right? So certainly maybe some increased concerns about inflation that you're seeing in the headlines. And when you break that down, Mark, it's interesting, and I don't think that's surprising, though, is that most of that is being driven by energy, oil,
prices,
right?
The war they're on, all of that.
Exactly. So I think it has begged the question of, as an investor, how should I be thinking about inflation? How should I be thinking about oil or energy? And what does that mean for my portfolio, bonds, stocks, whatever that might be? So certainly we've been having a lot of client conversations on this kind of increased maybe concern around inflation and how should I really be thinking about that?
It's a great setup for the conversation. I think before we dive into the inflation aspects of it, it's probably important. Let's go back in this particular session. Let's focus on the bond part of the conversation.
Okay.
And Suyan, maybe it's helpful to go back and maybe we deconstruct a bond and think about what are the components of the expected return of a bond. And then we can dive into the inflation aspect of that. How do we think about these higher prices?
Absolutely. And Jake, maybe if you don't mind helping me set this up, because I do think when people start talking about bond math, their eyes start to glaze over, right? So, Jake, maybe we could
Wait, why? You're the subject matter expert. Why are you putting me on the spot?
Because, Jake, I think you do a really good job of making it very accessible.
That's really nice of you to say.
Yes.
Okay.
And I talk about yield curves all day, every day. So sometimes I think I'm, in my own la la land.
And we do present a lot together,
We
so
do.
hopefully you have some confidence in me. But no, it's a good starting point, right? Like, let's think about something just as simple as a 10-year treasury. Like, why do you get paid for buying a 10-year treasury, right? You get the real rate, but then there's a term premium because there's a longer duration with that bond. But also remember this, that there's an inflation expectation that's baked in when you buy that 10-year bond, right?
That's exactly
and let's
right.
also remember that inflation expectations are baked into literally everything that's out there. The price of your house, any bond, any stock, anything like that.
All nominal asset prices embed the market's expectation for inflation. That's exactly right.
That's right. Now let's move to something like a corporate bond. So you still have the real rate. You may have a term premium depending on the length of that corporate bond. Let's just take a 10-year corporate bond.
Exactly.
It has an inflation expectation that's baked into it, but it also has a probability of default because you're not buying a U.S. government bond. You're buying a corporate bond. So those are sort of the components on how you get a return from a bond, which I think is a good starting point to say, let's focus on that expected inflation component as we start to say, well, what am I trying to do with inflation?
Exactly right. And I love how you mentioned that, Jake, because all bonds out there, right, if you're going a little bit further in a maturity or duration spectrum, have that term premium component. I like that you brought up, like, let's use a U.S. Treasury 10-year, U.S. corporate 10-year. And then I like how you said on the corporate side, you have to add that kind of credit spread, that credit premium, right? So maybe now we can take it a step back and talk now about, okay, well, now let's think through some of the components for a 10-year, let's use 10, keep this 10-year going, 10-year U.S. Treasury nominal, right? So if you Google U.S. Treasury 10-year yield, what's probably going to come up is that nominal Treasury. Now, what's important, though, is that the Treasury also issues TIPS. What are TIPS? Treasury inflation protected securities. Now, what's interesting is these are issued, nominal Treasuries and TIPS are issued by the same people, right? The U.S. government, same issuer, backed by the full faith and credit of the U.S. government. But when you look at the yield on a 10-year nominal Treasury versus a 10-year TIPS, they aren't the same, right? If you Googled this, and I'm just going to use a hypothetical example to keep it clean and easy to understand. Let's say you see the 10-year nominal Treasury yielding about 4%. Now, Jake, do you think that the TIPS is going to be yielding 4%?
Nope.
Probably not, right? What you see generally is that 10-year TIPS is going to be yielding lower. Let's say in this example, we're going to use 1.5. So I said nominal is at 4, TIPS is at 1.5, but they're the same issuer. They don't have credit, risk. They're the same issuer. They're the same tenor. We're using a 10-year example in this scenario. So why are we seeing that spread? 4 minus 1.5.
It's the inflation component that's basically baked into that difference between the nominal and the TIPS, because with the TIPS, you're taking that unexpected part off the table.
That's exactly right. That spread, that 2.5% spread in this hypothetical example, is embedding the market's expectation for inflation, right? We mentioned at the beginning of today's conversation that all nominal asset prices already embed the market's expectation for inflation. So that's what that 2.5% is implying. Now, you'll hear us talking about at Dimensional that if you want to protect against unexpected inflation, TIPS and other securities that are indexed to inflation can be really good instruments for you to achieve that. So I think this is why it's important to dissect what's already expected, what's already baked in, and then anything above and beyond what's already expected is where TIPS are going to help protect you.
And it goes back to the headline we started with, expected. And that's really the key word here. So I'm an accountant, so I like to sort of the building blocks of adding it all up. I'll go back to what you started with, which is, hey, you start with the real rate of interest, which is in this case at 1.5%. You add on to that an expected inflation rate, which is the 2.5%. We get to our 4% on, let's just say, a 10-year nominal. And again, as a reminder for the audience, nominal has that expected inflation number in there. And then, of course, for credit, you would add on whatever that credit adjustment is there. But let's just focus on where you were going there, Sion, on sort of that 10-year Treasury expected inflation rate. In this example is 2.5%. Yeah, but I'm worried perhaps about the unexpected inflation. What if it's way more than that? What is the impact of purchasing power? What does that mean for my portfolio? So let's go into that part of it. As an investor, how do I think about this unexpected? Meaning, what if it's worse, perhaps, than what's priced in today?
Mark, I really like that example you set up because you really decompose it really nicely, right? That real rate is at 1.5 plus the market's expectation for inflation at 2.5. That's how we're arriving around that 4% on the nominal treasuries. But you mentioned, what if real or actual inflation is higher than that 2.5, what the market expects? Let's say it comes in at 3, 3.5, 4. That difference between what the realized inflation is and the market's expectation inflation, that's where that TIPS is going to protect you because you're receiving actual inflation in your TIPS. So let's say it is 3%. I mean, this is very high level. There's a lot that goes under the weeds, but let's just be really simple. 1.5 is the real, plus actual inflation at 3, now you're at 4.5%. So that's where you start to see that protection in the tips if actual inflation is higher than what the market expects.
So if I'm an investor and I say I am worried about inflation more than what's priced in, that unexpected component, I can go buy a TIPS and the value of that bond is adjusted for that unexpected amount, right?
That's
how I make
exactly
up
right.
the difference there.
And I think, again, in summary, if realized inflation is higher than what the market expected, let's say in 1 year's time, all else equal, you would be better off holding TIPS, right? But the inverse is true as well. Let's say realized inflation actually comes in lower than what the market was expecting as embedded in market prices. You would have been better, all else equal, holding nominal treasuries. So I think it's an important distinction to kind of see both sides of the coin. And again, what is that key component is really looking at the market's expectation today, and then what is different from that expectation going forward.
All right, let's bring up some other questions we get about hedging unexpected inflation. So ready for these headlines? Is Bitcoin the new inflation hedge? Commodities versus gold, which is the better inflation hedge around that? So we do hear that narrative a lot in the media, a lot from investors about, well, maybe I should give me some gold or Bitcoin.
Totally.
Which I chuckle on the Bitcoin one. Well, gold too, because you think about it in a hedge. If you have a proper hedge, like it should move in conjunction with whatever it is you're hedging against, the value, the price of that, the value of that. Okay, what does Bitcoin do? It is all over the map. It's so volatile. The price swings on that thing are
quite
so
the
massive.
seesaw. Yep.
It's really volatile. Gold is really volatile too. So I wonder if the media they don't quite get it right in the way they talk about perhaps gold, commodities like that, where it's not so much in hedge, which gets to the other part of the conversation on inflation is you can hedge or you can try to outpace.
Yeah.
And so let me give you some numbers and I'll get your guys' thoughts of how you think about some of this when you think about gold or some of these different deals that is an inflation hedge. So we're going to go back to the time period. We have gold, information on gold, 1970 through 2025. Over that time period, CPI was 3.9%. So what that means is if something cost $1 in 1970, it's now going to cost $9. That's kind of that growth of that dollar over time. Gold had a really nice return over that time period. It was up 9.0%. So that would have generated a growth of $1 to $122. So that's where I wonder if what they mean to say is it's really more of an outpacing strategy when you look at the historical data as opposed to true inflation hedge. For any given time period.
I like that framework because if we look at, and right now energy or oil, right, is so hot right now because we're seeing, oil prices up quite a bit. So I think it always begs the question, are maybe real assets, should I be using those to hedge inflation? Well, when we look at some of the information, we do see that some of the more like energy stocks or commodities, which include gold, Mark, to your point, do tend to be correlated with moves in inflation. But when you look at the volatility, Mark, they are 20 times more volatile than inflation. So it begs the question, should you be hedging the variability, if you're trying to reduce the variability of something with something incredibly volatile? That doesn't really make sense. But to your point, Mark, it now goes to, well, are you trying to just beat inflation? Because that is a very different argument than trying to hedge against unexpected inflation. And we've done a lot of work on that too, looking at several different asset classes, stocks, nominal bonds. And what we have found is going back to the 1920s, that most asset classes actually outpace inflation, even in higher inflationary periods, with the exception of one asset class. Jake, do you know which one that is?
T-bills.
T-bills, right? So as long as you weren't in cash, shoving, cash under your mattress, even in higher inflationary periods, on average, you were beating inflation. So I really like that argument because they are very, very distinct goals. Outpacing inflation, you've got great growth assets for that, right? Nominal bonds, stocks. And then if you're trying to hedge unexpected inflation, don't be using really volatile instruments. Use something that literally tracks CPIU.
And the reality is that, I mean, look, I'm not going to make a blanket statement for every single investor that's out there, but we do a lot of work with financial advisors. We talk with a lot of people during the course of years. We just said we're on the road all the time.
Yep.
And when you talk with them, you're like, look, for the most part, a lot of investors' goals actually lean maybe a little bit more towards the outpace side than perfectly hedge unexpected inflation. I mean, look, if you have a short-term liability or a liability that you can clearly identify and it's sensitive to inflation, great. Figure out how you take unexpected inflation off the table. If you're a pension fund and has long-term liabilities that are sensitive to inflation, great. That's like asset liability matching and cover yourself on inflation. Like we know how to do that. Most investors, though, probably lean a little bit more towards, okay, inflation is going to be whatever it's going to be. I got to figure out how I'm not only going to maintain purchasing power, but I probably want to do a little bit better. And that's when we start to move into some of these areas of stocks or subsets of stocks. And it gets back to what you said is, what's the right tool for the job? That's what you want to think about. Define my goal and then figure out how I apply the tool to accomplish that goal.
Well, let me run with that and give you some more numbers around the right tool for the job. So if the goal is to outpace inflation, we talked about gold doing that over time, but what if you look at just stocks in general? So the S&P 500, I'll stay consistent with that 1970 through 2025 time period. The S&P was up 11.1%, which would have generated a growth of $1 of $3.57. Now here's the kicker. If you look at other asset classes, like both of you guys were talking about, small value up 14.4% over that time period. And this is astonishing. It just shows the value of compounding over time. But the growth of wealth, $1,826, which is massive compared to the other one. So again, going back to Jake, know what you're trying to accomplish, get the right tool for the job.
I think that's right. And also too quickly, we were talking about kind of that hedge piece of it. And let's remember that we're talking about tips because we were trying to give an example there.
Yes.
But there actually are other ways to hedge unexpected inflation as well. Like you can look for strategies that maybe apply an inflation swap, which is a similar concept of I'm going to take unexpected inflation off the table. But depending on the strategy, you might be able to shorten up the duration so that you don't have a 2022 where you have a lot of real rate risk and you're surprised on that side. So just a reminder that define your goal. And if you lean towards the hedge side, no issue there. But you actually have a few more options beyond just tips.
I like that, Jake, because I do think there are, great strategies out there that employ, like you mentioned, inflation swaps that actually are indexed to that same CPIU, non-seasonally adjusted, so the same CPI number that tips are indexed to, but you can get a little bit more customization and flexibility through these kind of swap overlays. You can, like you mentioned, maybe have a little bit of a shorter duration. Tips are great. They do a really good job of hedging against unexpected inflation, but like I mentioned, they're U.S. Treasury instruments, right? So you're not getting a credit premium. Maybe you want a credit premium, so you can have a little bit of customization there. What about taxes? Like maybe you want to have a little bit more of a tax efficient approach and you want some asset location flexibility. Inflation swaps can certainly help with those pieces of the pie as well. So certainly explore out there. There are some really good strategies that employ those inflation swaps if you are looking for a little bit more customization and you don't want to forego that hedge against unexpected inflation.
I just love what you said there, and you know me, I kind of geek out on fixed income in general with you,
and
I think the reason I do is because there's a lot of different levers you can pull within fixed income depending on what you're trying to accomplish. Is it a total return approach? Is it capital preservation? Is it inflation protection? Is it tax sensitivity on all of that? And it's really cool now that these are the conversations you want to have with your financial professional. These are potentially what you want to understand from an asset manager, which is, here is what I'm trying to accomplish. How can we do that in the best manner possible?
Get with your financial professional. Right, there's a lot of good solutions out there. Make sure you're aware of them and use them as appropriate for what you're trying to accomplish. The other thing I will do to wrap up the conversation here, I'm going to go back to the headline again, which is important for the audience.
Sure.
Inflation, interest rates expected to be higher for longer. So markets don't just say, hey, I'm going to wait 3 months and then prices go up or interest rates perhaps may go up, right? That's reflected today. So everything that we know today is already in that price. And so could they be higher for longer? Maybe. But again, that's already in the price today. And so if you're worried about unexpected inflation, again, tips or some sort of inflation protected solution could be very good for you. For the longer run, stocks are great outpacing strategies.
Yeah. I like how we really dissected that today, because when you're looking at just the headline of inflation, I don't think you see the nuance of there's actually a couple different goals that you're trying to achieve here. And I like that how we talked about the unexpected versus expected, which is huge. And I think to the layman, they don't really think about that. But you're absolutely right, Mark. Every single day, those break-even rates, right, are changing, right? That market's expectation or that spread difference between nominal treasury and tips are changing, which is incorporating new information about what the market's expectations are. So pay attention to that. Think about that as an investor, that expected versus unexpected. And then maybe you're okay with taking on some variability in your assets are not as susceptible to purchasing power risk. And you're just trying to grow your wealth and make sure that over long periods of time, you're not eroding the real value of your assets. Our research has found that stocks, nominal bonds even, are a really great tool to help you with that goal. So I think that was a really great way of wrapping it up, and I hope that was helpful for people today.
I'm sure it was. So, Jan, great to have you in the studio. Thanks for joining us today. Jake, as always, I love the energy you bring for bonds. It's fantastic.
I know we got to get Jake on become a bond PM.
I'll tell you what. I mean, I make the joke. I'm like, hey, how many of your clients? I say as financial professionals, how many of your clients are getting younger? Right. And they're not. And my point there is that for a lot of people, bonds become really important through time. And yet people always tend to focus on the equities. I'm like, you should spend some time on some bonds.
They're incredibly important, and you bring energy to it. So thanks to all of you for attending the Informed Investor today. We appreciate your time. And be sure to check out a newsletter from David Booth, our chairman here at Dimensional. It is called Stay Calm Investing, and you can find the link in the show notes. And also be sure to subscribe to the Informed Investor, and you'll know exactly when we post future episodes. Thanks again, and have a fantastic day.